Good afternoon, everyone. Thank you so much for joining us again for another Tuesday Barometer Readings webcast. I'm Pamela Hastings, Relationship Manager here at Barometer Capital. And joining me today, as always, is our Chief Investment Strategist and President, David Burrows. Today, David will be providing us a brief macro overview. We'll be talking about the market and how it's been consolidating as of recently, and how we think this is a time correction. David will be speaking on how the portfolios are positioned to grin and bear it and go forward well into the end of the year. With that, as always, we are happy to take your questions. You can email me at phastings@barometercapital.ca or hit me up on the Zoom chat. We'll address those questions at the end of the conversation with David. And over to you, David. Happy Tuesday afternoon, coming off of a great long weekend. I hope you had a wonderful Thanksgiving with your family.
We sure did. It was a wonderful Thanksgiving. We got a couple of really nice days, but boy, it feels like fall is in the air today. Weather's changing, and I guess we're into another season of Zoom calls. At some point, we're going to be out of this COVID situation, but for now, we continue to be here. So this has been a great medium to discuss kind of what's going on market-wise, what we're seeing through our lenses. And I thought maybe we could push the ball along here. We have been in a consolidation over the last few weeks. It was our view coming into the fall that conditions really were not set up for significant volatility, but probably more marking time. And that has been the case up until now. I think that we're getting a little bit more color as we go along. And while we always remain open to the possibility that things could get worse, I think that we're making progress here. So let's start from the top, as we always do. We believe we are in a structural bull market that started in 2013 in equities. U.S. market led off the bottom, and over time, other markets have joined. And structural bull markets are marked by sort of 4 steps forward with 1 step back. Long consolidating runs in the market. And secular bear markets are more sideways action, sort of 2 years up, 1.5 years down, where you don't really make a lot of progress. It's a very different type of market. It's a much tougher market. There tends to be very little leadership. In a structural bull market, there tends to be solid leadership groups that are advancing consistently. Sometimes the nature of the leadership shifts along the way, so you have to be watching for that. But at this point, we continue to believe that we are in an equity bull market. As far as rates go, we think that we've been going through a bottoming process over the last couple of years, and that we've seen probably generational lows, much like we did in the late 1940s, early 1950s. I think we're getting more evidence that that is the case. And we also have talked about the fact that we thought we were at sort of multi-decade lows in commodity prices that were in the process of making a turn, much like they did in the early 1930s. Now, this chart, I don't talk about it often, but it really just shows rolling 10-year returns. And when you get to a point where the rolling 10-year returns are solidly negative, often you get to a point where that can start to make a turn. I thought maybe I'd update that chart today. This is that same chart looking at a shorter window. This is the early 1930s, almost negative 10% 10-year rolling returns. And then ultimately we crossed up through the zero line. You got about another decade of rising prices. And we've just done exactly that. We've gone from about 6.5% negative 10-year returns for commodity prices as a whole. And they've made a turn and turned positive here for the first time in many years. And so this is, I think, further evidence that we are in the relatively early stages of a commodity structural bull market. And that's important, in the Canadian marketplace, our local market, lots of exposure there. It's a relatively small part of the S&P, but really gives us opportunities to take advantage of an under-owned group and one that is not well understood, certainly by younger investors. So there's the RJI, which is the Rogers Commodity Index. It's made up of a basket of global commodities, agricultural commodities, hard commodities like metals and energy. And you can see that we broke this 10-year, sort of 13 years bear market, started in 2008. And these are monthly bars. We've sort of been marching slowly higher. And in fact, commodities now looking backwards, outperforming the stock market over the last year. And it can go for many years like that. So this is something that we're certainly keeping an eye on in our multi-asset portfolios. This is the more recent picture. The Rogers Commodity Index continued to firm up again over the last week. We know that there's been strength in energy, of course, but other commodities underneath the surface, and we'll talk a little bit about that. We've talked now for the last few weeks about the fact that, and it's no surprise to anybody, this is a choppy period of the year. This is a composite of data from 1950 to the present. And from the beginning of September through the 40 days leading into the late part of October, you often have choppiness, and we have had sort of choppy action. We've had somewhat less volatility in price than we have had in many other years. It is the case that when you've had such a strong market from October of last year into this year, you might think that should mean that we should have bigger volatility, but in fact, it's just a very strong market and able to absorb a lot of bad news. And this market, I think, has surprised a lot of people. The level of bearishness in the market coming into September was quite extreme. Institutional investors had taken down exposures quite dramatically. And interestingly, you know, it really hasn't turned into much so far. So lots of things that people have been worried about, and we talked a little bit about these last week. We prefer to let the market show us what's happening as opposed to prognosticating what should happen. And so we're going to take a look at some pictures here to just assess what we can take from sort of the health of the market. Here's the S&P 500. It was in a channel from October of last year through up until the end of August, where we came down out of that channel. This is the chart we looked at last week. Sort of top to bottom, about 5.9%. To the worst point. This was as of last Monday. And if we fast forward by a week, we'll look at the fact that we bounced a little bit going through last week, and we're now slightly higher level. So far, we've held these lows 4 or 5 times, and not to say we won't test them again, but we are getting to the end of the seasonal weakness window. Now, we talked last week about the fact that each successive push lower, fewer stocks in the S&P made a 20-day low. So the first push lower at the end of August 20th, 63% of stocks made a 20-day low. When we pushed down again in the middle of September, only 41% of stocks made a 20-day low. And then last Monday, 26% of stocks made a 20-day low, meaning that fewer and fewer stocks are getting pushed around by the market. It happens, in fact, to be some very large cap stocks that have been weak over the last couple of weeks. And that has had an bigger impact on the NASDAQ. But the average stock has been gaining ground versus the market cap weighted S&P 500, meaning the average stock doing better than the very large caps. So we talked about the fact that while the S&P sort of was down 6, the average stock to the worst point was down about 13. I hope you can hear this in the background. I got a tremendous rainstorm going here. Nice to hear. And when we look at the Russell 2000, we talked about the fact that the Russell 2000 mid-sized companies have basically been correcting now since really March. So markets correct 2 ways, and I get repetitive, I suppose, saying this. But when they get really ahead of the moving averages, either they're going to pull back in price toward the moving average, or they go sideways long enough for the moving averages to catch up, meaning that overbought condition, the very strong bullish sentiment gets a little bit washed away, and we get ready and set up. The energy gains energy to be able to take off again. So now we remain open to the fact that this could break lower. We're going to look for some clues today as to what may be happening under the surface. But my guess is over the next couple of weeks, we're going to go one way or the other here. And we're going to have to take our cue from that, among other things. So we watch the average stock very closely. The S&P 500 is interesting to talk about, but the value line geometric index, which is all stocks in the US, or the Russell 2000, tells us a lot about what's actually happening under the surface. So let's move forward here. Let's talk about bonds for a moment. No, it's not a very exciting topic, but it has a big impact on what does well in the market. This is the price of a 10-year bond. We know it made a high in March of last year, then pulled back. It made another high in July of last year, but a lower high. We know that bond prices have been going higher for years, and yields have been going lower for yields, which is very supportive to companies that do well when yields are falling. But then we went into a pretty major correction in the bond price. 10-year bond fell from $172 to $139. That's a big percentage point drop. And of course, it got ahead of itself and had to correct. So of course, we rallied through the spring and summer and corrected that sort of overdone sell-off. But that being said, looks like it started to roll over again a couple of weeks ago. So this is the 30-year Treasury bond, the TLT, 20 to 30-year bonds. It's an ETF made up of a composite of long-term US government bonds. That's the high spike in March. That's the second high at the end of July, and a series of lower lows and lower highs into March, when we bounced back up into the moving averages and then failed to make a new high. And in the last 2 weeks, the bond market really has rolled over across the curve. 1-year bonds, 3-year bonds, 5-year bonds, 7-year bonds, 10-year bonds, 30-year bonds, really across the board. And that has implications, of course. When we look at stocks versus bonds, we know that bonds underperformed the stock market from March of last year through until the spring. And then they corrected. But when they corrected, they really didn't make up any ground versus the stock market. And then recently, we've seen them break all of these lows and now once again rejoining a downtrend versus stocks. So important implications for asset allocation. Makes it very difficult to have a big bond weighting in a portfolio, even though some people feel that's somewhat more conservative. I think there's a lot of risk buying a bond when we are at generational lows in interest rates, because ultimately as rates go higher, bond prices fall. So continue to be bullish stocks, bearish bonds. And in our work, as you remember, it's all about finding leadership. We don't need to be everywhere. We need to use the tools that we have to recognize change. We're prepared to change our portfolios when it's required. And there's times to play some defense. It's time to play defense in the bond market right now. And it's time to play defense in things that act like bonds, because they can have a negative impact on the portfolio. Okay, so let's keep going. So let's talk about the data this week. First of all, employment. Last week, we had employment data that came out at the surface being quite disappointing. Job growth has been recovering off the pandemic lows. You can see the trajectory has really slowed, and last week's number was downright disappointing to many. I think there's a couple of things to take away. We talked recently about the fact that the job openings, unfilled jobs, are spiking to multi-year highs. And when we look at the jobs data from last week, yes, the unfilled jobs came down somewhat, but the new jobs came down as well. Now, I would say it's more likely that companies are having a hard time finding employees that meet what they're looking for. So it's something that we're going to have to keep an eye on, because it does have an impact on the consumer, but still lots of jobs outstanding, just not so many of them getting filled by qualified employees. Let's talk about leadership themes. Over the last few weeks, we highlighted that if we thought we were headed into a difficult market, then investors would be moving their feet, moving assets from economically sensitive or offensive assets to defensive assets. So high beta, more volatile stocks versus low volatility stocks certainly did a little better as we went through the spring and summer. But interestingly, since the end of August, higher beta stocks are outperforming on a relative basis. Consumer discretionary spending versus staples, things we have to buy, consumer discretionary stocks outperforming since late August, and transports, moving stuff around, versus utilities, predictable and defensive, outperforming. So we highlighted the fact that a lot of the risk barometers are telling us something different than the way people are feeling. So let's move forward. We mentioned last week that cyclical sectors were starting to see net inflows again after correcting through the summer. Let's look at another barometer. This is in white, the US Bank Index, which obviously is tightly tied to the economy and creditworthiness, versus the yield on a 10-year bond. And we see the yield on a 10-year bond starting to rise and bank stocks starting to rise. Bond yields move higher for a couple of reasons. Yes, of course, if they think there is inflation, but also if we think the economy is stronger and there's more growth. It would be unlikely if we thought there was a big problem in the economy that banks would be outperformed, but on a relative basis, they've been rising over the last few weeks in a seasonally difficult period when you would think that people might want to be a little bit more cautious. So this is the IAI ETF, the broker-dealer ETF. You can see we're trading virtually at new highs. And on a relative basis since July, this has been improving relative to the S&P. And these are highly market-sensitive companies: Morgan Stanley, Goldman Sachs, LPL, Charles Schwab, Raymond James. These are brokers and asset managers. Things that get impacted by the market. People get concerned about the market, they're more likely to get more cautious. Now, we can talk about big themes, but then our job is to find companies within the mix that are going to outperform the themes. And we've talked about First Republic for quite some time. This is a bank that has been a high growth bank and doing a great job at growing its dividend, made a new relative high today versus the stock market. This is the KIE, the insurance ETF. Again, their success is tied to their ability to generate a return on the float, on their stock portfolios, on their bond portfolios, on their investments. And we can see that in the last few weeks, very strong relative performance versus the stock market. They're helped by higher interest rates, of course, as well. But again, counterintuitive if you think that we're headed into a problem. Now, this is another way of looking at things. This is looking at the relative performance of the commodity index and all world stock index. And you can see that these had been consolidated. This comes courtesy of All-Star Charts. And I thought it was interesting to make a point, you know, after having a very, very strong run through the late part of 2020 and early 2021, sideways. Okay, again, consolidation comes two ways: in price or in time. Commodity prices moved sideways and global markets moved sideways. Let's take a look at what's happening under the surface. Energy, probably the most important commodity, very strong relative performance over the last few weeks. This is really since the beginning of August, just almost a straight on run in the energy producers in the Canadian market. And of course, we're trying to own stronger companies than the index. I'll just run through a few of our favorites. Baytex Energy, which has had a wonderful run. This is a $2 billion oil and gas company, lots of oil, light oil exposure, running on to new highs. We have Tamarack Valley Energy, another mid-cap stock. This is a $1.4 billion market value, again, making new relative highs and absolute highs. Advantage Oil and Gas fits into this camp as well. We've talked about Tourmaline. We've talked about Canadian Natural Resources, you know, the $59 billion giant in the Canadian marketplace. This is a very strong sector, and this is a group that we've continued to weight up. Agriculture's continued to act very, very well, especially relative to the stock market. Again, we're looking for strength in that group. Nutrien has been a big holding of ours, just constantly making relative new highs versus the market. These are economically sensitive companies. Uranium, after a very long sideways period for uranium producers, we broke out, we consolidated, but like that flag in the overall commodity group, we've broken out to the upside. And then when we look at specific names, one that comes to mind is Cameco. Of course, it had that same consolidation, but a bigger move higher, and now a very strong move today, up 13% on the day, on a positive article in Financial Times about use of uranium and nuclear around the world. We talked a little bit about copper being an important indicator for global expectations for economic activity. Certainly no major sign of stress here. It has been consolidating, but making higher lows. And when we look at some of the major copper producers, of course, Freeport McMoran would be the most important. It actually broke out yesterday of that flag, and under the surface, some of the companies that were focused in Foran mining had just a giant day today, up 17%. So what I would say is that companies and sectors that give us advanced signal on what expectations are for economic growth and the health of the market are giving us some pretty positive signals. US economy is 70% the consumer, and we don't have a ton of consumer discretionary exposure because we do think that many of them are somewhat vulnerable to rising costs. In fact, the consumer discretionary sector has, on a relative basis, been improving since August, again, after having consolidated from the spring. And there's a raft of companies and groups within there. We talked last week about travel and leisure. Of course, this is the health of the reopening. It's having a nice relative move versus the market. Ford Motor Company is a great example. We know that cars are in short supply. We know that Ford is making a major push towards EVs, and the market seems to like it. It's a very inexpensive company, but again, a good indicator as to what people are expecting going forward. Now let's talk about incumbent leadership, because we've talked over the last couple of weeks that we're a little bit more cautious on tech. This is a chart that comes from a friend, Chris Cavacchio. He looks at relative performance of technology versus the S&P 500. And we know that tech peaked out in February and then went for a period of time where it consolidated. The rest of the market played catch up. And then ultimately tech reversed and started to rally through into the spring, but really hasn't been able to make any headway back versus the S&P since. And in fact, while the S&P, some of those groups we just talked about are making new absolute highs, new price highs, and new relative highs versus the S&P, tech has been unable to reclaim the relative highs from February last year. Now, we think this is important because we think that almost every investor is full to the brim with large cap growth stocks, and they're great companies. Amazon is a wonderful company. Apple is a wonderful company. Microsoft is a wonderful company, but they're well owned and they're very highly priced, and their relative performance now is waning relative to the rest of the market, which means there's an opportunity. If tech is 40% of the S&P 500, tech and communications, if we don't own as much and we can own more of the groups that are small groups within the S&P, are underowned and are relatively outperforming, we think A, there's an opportunity, and B, there's a message in this. If we thought the economy was about to roll over, economically sensitive stocks, companies, sectors would not be gaining performance on the S&P, they'd be losing. And if we were concerned about long-term growth, investors would be more confident buying companies they know have a long history of growth, whether the economy is growing or not, and that would be the technology sector. So just a message there, we want to be a little bit cautious on tech. We certainly are cautious on things that act like bonds, bond proxies, telecom stocks, which we've talked about, which really don't gain much when the economy gets stronger. Very weak relative performance versus the S&P recently. Utilities, very weak performance relative to the S&P. Now, you get a dividend, which is great, which is not in this price, but certainly that's a challenge. And healthcare, again, another group that is not very economically sensitive, relatively underperforming, and certainly getting a bit hit going through this corrective period. So let's just put this all in a graphic form. If we started a base of 100 on October 29th of 2020, just before the election, and just before we got that big bread thrust in the market, we know some groups have outperformed others. XOP, which is the energy sector, has had great outperformance. It had a really good sized correction in June, July, but it's just come roaring back. In that group, of course, is the uranium group, and it's very, very strong recently, and alternative energy acting quite well. Next on our list here is IAI, which is financials, it's broker dealers, Morgan Stanley, Goldman Sachs, and so on of the world. RJI, which is the commodities index. You can see these all strengthening recently. RDVY, which is the ETF that owns dividend growers, Interesting to contrast that against an ETF that owns the highest dividend payers, right? High dividend versus dividend growth, high dividend underperforming versus dividend growth. Here's the S&P in the middle, and then consumer staples and utilities sort of at the bottom of the pile. So our job is to pick our spots. As we stand, our most significant overweight continues to be in financials. We can't sit on the sidelines when there are groups performing well. I got asked last week, what would cause us to get more defensive? Well, of course, we look at our market indicators, and I can say that this week, 3 of 4 of our short-term indicators have turned back positive. So seasonally, that's interesting to see. Under the surface, the leadership teams that we've been focused on are performing quite well. Relative performance of financials, very strong versus the market. So we have a 3 times weight in financials versus the S&P. On technology, we're only a 16% weight. We get some wonderful companies. And I won't argue that they're the best companies in the world, but it's not really a secret. Energy is a significant overweight for us, and that's across nuclear, oil and gas, solar, a number of different energy technologies and medium. Industrials is about a market weight. When we go down, communication services is an underweight. Consumer discretionary underweight. Healthcare is an underweight. Materials is about a double weight the market. So we are very skewed currently. And one of the advantages I think that we have is when we get into a market where there are low correlations, meaning some groups acting better, some groups acting worse. Being an active manager and being able to have an active stance in the portfolio, not just plus or minus 1 or 2% from the benchmark, can give us a real advantage. And when these kinds of markets get going, they can go for a long time. I've talked about reflation over the last year a lot, and I believe we're in the very, very early stages of reflation. There's a mountain of money in the bond market. There's a mountain of money in companies and sectors that act like bonds for good reason. They've worked for 30 years. There's not very much money in the more reflationary sectors, and we think that there's a real opportunity there. And that may not be good for the S&P 500, given the current makeup of the S&P 500. So active versus passive really kind of has an opportunity at this point. You know, we're willing to get defensive for sure if the signals are there, but really we're not seeing it. Global financial conditions continue to be very easy, loose, lots of liquidity. Now, the fact that the market has corrected 6-7% since the beginning of September, that tightens conditions a little bit, but you can see relative to history, we have very loose financial conditions. When we look at credit spreads, the bond market's assessment of the credit worthiness of investment grade issuers and high yield issuers, there is no sign that we are headed back into some kind of a credit problem, despite the fact that we're all concerned about COVID. When we look at volatility, this is one of our crazy point and figure charts. Remember, what we're looking for, if you think something's going higher, is higher highs and higher lows. Well, volatility spiked at the end of August. When the market went back to lows again in the beginning of September, it failed to make volatility failed to make a new high. When the market went back and actually made a lower low at the beginning of August, failed to make a new high. And now, of course, as the market's rallied a little, volatility is falling, and now we've broken all these previous lows. And so volatility is selling off. That's not a market where people are trying to get hedged. It may be a market where investors are over-hedged. So you can see we continue to be kind of in this sweet spot zone where low volatility tends to be associated with longer term, better investment returns in the stock market. Earlier in the summer, we mentioned that we had seen a change in investor sentiment from being very bullish in February to less bullish. When we look at it today, those AAII investor sentiment bullish readings continued to come down and got solidly into the zone as to where we see corrections come to an end. Unless, of course, you're heading to a bear market like we had in February, March of 2000 going into COVID. Certainly no conditions look similar today, and also similar to the really overbought nature of the market in late 2018. Again, very, very different than what we're seeing today. So sentiment has been reset as the market has been going through this correction. And just slicing it up another way, and I don't like to put too much weight on this, this takes investor confidence by managers who have had a history of poor market timing. Well, they've become very, very cautious. And those that have had a history of better market timing and making better market calls actually have been getting markedly more bullish. So we'll take that for what it is, but many successful managers who have had success in sort of allocating capital based on market conditions are becoming more bullish. Based on what I see, the commodity groups strengthening, more economically sensitive groups strengthening in a weak season for the market, that is foreshadowing, I think, stronger markets. When the leading stocks start to break out ahead of their groups, like some of those we looked at today, that tells you that more are likely to follow. So we're getting great dividend increases out of financials and industrials, certainly lots in tech as well, very few dividend cuts. That's positive for our dividend growth strategy. As I mentioned, dividend growth continues to outperform high dividend. I think that will be the case for years as we move through a period of rising interest rates. And of course, we'll get defensive if our work was to get point to more defensive conditions. But as it is, we're still pretty fully invested. So with that, Pam, if there are any questions, maybe we could take them.
Absolutely, Dave. Actually, we're going to switch topics into the world of music royalties. And we'd love to get your comments on this. It came across the newswire this afternoon. The Blackstone has invested $1 billion in the music rights. And there's talk that billions could be more invested in this space. I know we have a music royalty strategy and one of the first Canadian players in the space. Would love your comments on and where you think this space is headed.
Well, it's interesting, so Greg came to me a few years ago, and Greg's been very, very good at recognizing industries going through a major shift. And of course, he was very early in the income trust move in the Canadian market and felt that they had a lower cost of capital. It was very interesting. And certainly when fracking started in energy, we were very early to get involved in some of those companies, and there was a great run there. We know that asset classes go through major shifts. If I go back 15 years, as rates were really starting to fall, and institutional investors started looking at buying buildings as an alternative to buying a 10-year or 30-year bond, because it was predictable income coming over a long period of time. It was a long life asset. And of course, yields went on buildings from sort of 10% returns to down to 2 or 3% cap rates by the time it was done. And so we thought that music was ripe for that, because we could get almost 10% returns on the money with some dividend growth in a world where long life assets, pay you too. And we felt that sooner or later, investment capital will recognize these are very predictable assets. The copyrights last the life of the artist plus 70 years, and great songs are played forever. So we started that first fund, and it did very, very well. And now we're in our second. It's interesting what's happening, because that news in the last few weeks, we have had news that Apollo Group, which is one of the largest private equity investment managers in the world, has formed a large fund. KKR has coming forward to put a fund together. Blackstone Group has come together to put a fund together. And that's important because it's money being brought to bear in the space. It legitimizes the asset class. But what I think that we have that they may not have is that we have very strong industry partners who have relationships with all the artists, and not just the artists, but the songwriters and the beat makers and the people that write the lyrics. And they've been collecting their royalties for them for years. And it's one thing to have investment capital. The other thing is to have relationships with people who want to sell you the assets. And so I'm excited about the fact that we have some big players coming into the space, because ultimately, when pension funds and large institutions started buying real estate, that was 15 years ago. And they pushed prices for 15 years from 10% yields down to 2%. And I have no doubt that that will happen in this asset class in a similar way. But I think that where we have an advantage is we have an advantage in the opportunity to buy these catalogs that people don't necessarily know are for sale. So it's interesting, and it's interesting to see the evolution happen when these shifts in asset classes occur. And that, of course, has always been our thing: recognizing change before it's obvious, and getting invested, and then letting people come in behind us.
Thanks so much, Dave. That concludes the questions that we've received today. I will leave you with the final word.
Well, here we are. We are about the middle of October. I think of years past, and the markets have not been so friendly at this time of year. In my first year in the investment business, 1987, it was October 19th. We got a nasty surprise. Interesting enough, that crash and the deterioration in the market had been happening for 6 months leading into that difficulty, and was very well telegraphed. There's no crash that ever took place while the market was above its 150-day moving average, and while the moving average was moving higher, which of course it is right now. So I'm always happy to see October pass. We'll see how things go over the next couple of weeks. But I'm very encouraged by the fact that the important groups in this market that we need to have on board to have a constructive market, in many cases, are starting to break out to the upside. And they happen to be the groups that we're focused in, so that won't hurt us too much. So with that, thank you very much, Pam, for hosting again.
That was a pleasure, Dave.
If folks out there have topics that they would like us to cover in future webcasts, please send them along to us. If you got questions you're too shy to ask, shoot me an email, or my number's on the bottom of every email I send out. I'm happy to get calls on my cell, and I know our investment team are happy to field questions. I think that we're into a very interesting time, because this next leg higher, I think, is going to surprise a lot of investors. Thanks, Pam, and thanks everyone for joining us.
Thanks so much, Dave.